Welcome back. In this video, we will learn about the income statement. The income statement reports revenues and expense for a specific period of time, where revenues is anything resulting from business activities for the purpose of earning income. The most common type of revenue are sales. Expenses are the cost of assets consumed or services used in the process of earning revenue. It can be also referred to as the P&L or earnings statement. An income statement gives a company full overview of its revenues and expenses over time. It gives key insights into the health of the business and helps management to make the right decisions. Company 1 has a revenue of $300, $200 in expense, and thus a profit of $100. Company 2 has the same revenue but $400 in expense, resulting in a loss of $100. To understand the income statement, it's important to grasp its key metrics: gross and net revenue, and gross and net profit. Let's dive deeper into all of these to better understand them. Gross revenue are earnings without subtracting expenses. Our lemonade business is flourishing and we're expanding into selling juices. If we sell 10 juicers of $100 each, gross revenue totals $1,000. Net revenue are the revenues minus discounts or money lost from product returns or missing products. A simplified formula for net revenue is gross revenue minus discounts minus returns. One of the 10 juicers we sold to a customer was defective, so we had to return $100 to the customer. Our net revenue is thus $1,000 minus $100 or $900. Our net revenue is the amount a company keeps from its sales. Gross profit is the profit a company keeps after subtracting the cost of goods sold, or COGS, from its net revenue. The cost of goods sold include the direct cost of producing the goods sold by a company, such as the material used to create the goods. Let's go back to our juicer example. The 10 juicers of which we had to return money for one damaged juicer had a cost of $60. Our gross profit is thus $900 minus $600 for a gross profit of $300. Net profit is the profit earned by a company after subtracting COGS and expenses. A simplified formula for net profit is thus gross profit minus expenses. Net profit is often referred to as the bottom line because it's positioned at the bottom of the income statement. If we subtract 2 times $50 from our previous example, one deduction for salary and one deduction for taxes, we arrive at a net profit of $200. In summary, gross revenue is the total earnings a company makes. Net revenue is the gross revenue minus discounts and returns. Gross profit is net revenue minus COGS, and net revenue is gross profit minus other expenses. There is one more metric we have to go through: EBITDA. EBITDA, or earnings before interest, tax, depreciation, and amortization, is a measure of profitability. It's an alternative way to look at profitability of a company. Don't worry too much about this metric for now, but know you'll see it throughout this course. If you want to learn more, you can use Investopedia.com, which is a great resource for financial information. To summarize, the income statement reports revenues and expenses and allows you to know your net profit or loss for a specific period of time. With a better understanding of its key metrics, you're ready to